What is the real difference between a bull market and a bear market? In the next few minutes, I will break down exactly what a bull market and a bear market is, how to recognize which one we are in right now, and most importantly, how to make money in both. So by the end of the video, you don't have to guess again. But alright, so the very first question we of course need to answer is, what are bull and bear markets in the first place? And let's actually begin here with the bull market. So what is a bull market? How do we define a bull market? Well, in general, we define a bull market as a market where prices has risen 20% or more from the lows. So if you take a look at this image right here, we can see that this, by the way, is Nasdaq. And we can see that the very lows here was almost down at 10,000. So when the price, the general definition is that when the price rises 20% or up to 12,000 in this case, around there, we are in a bull market. But I can just right away mention that it's some important differences here depending on what market you are looking in. So for example, I would say that this is true for stock markets, then this 20% number is pretty accurate. But if you are, for example, looking at cryptocurrencies, then I would actually require a larger increase in order to switch between these bull and bear markets. But we will talk more about that soon. But another general thing that is always true for bull markets is that investors and traders are optimistic and confident. Also, when we're looking at the stock market, we are seeing often, or pretty much always, we're seeing economic growth and expansion. The next point here is that we also in bull markets have low unemployment rates. And last but definitely not least here, and this is very important, the average duration of bull markets tend to be around 5 years. But here, this is also will differ a bit depending on if you are trading in the stock market or if you are trading cryptocurrencies. And here, and this is also very important, is that the duration here of bull markets tend to be much longer compared to bear markets. And this leads us, of course, to take a look at, how do we define a bear market? Well, let's take a look now at the bear market. And as you guessed it, the bear market here is the opposite of the bull market. So a bear market is a market that has fallen 20% of or more. And here in this example, you can see this is also Nasdaq, and you can see that once the market fell more than 20%, we are officially in a bear market. But as I also mentioned earlier, depending on what market, for example, if you're looking at crypto, I'm looking for a larger drop. Most of the times, at least 30% or even 40% to really confirm that bear market. Another thing you want to look out for is that in a bear market, investors are fearful and more on the pessimistic side. When it comes to the economic data, we often see, general economic contraction and recession. We see rising unemployment rates, and the duration here of the bear markets are usually much shorter, around 1 year or so. But once again, it can depend a bit on the markets. When it comes to crypto, I have found that the bear markets actually tend to be longer compared to the stock market. For example, if you remember the COVID crash, we had a very, very short bear market. It was just like a few, maybe like 2-3 months before the price actually recovered. That was, in a lot due to all the money printing the government did. But in general, it will depend a bit here on the market. But for both the bull market and bear market, you can think about that the more of these factors than you can check, the more likely that we are in a bear market or bull market. So make sure you can go back to earlier in this video and make sure that you have the lists. But now, and this is very important, how do we know if we are bullish or bearish, or how do we know if we are in a bull market or bear market? Well, here I have made a list of things to look out for when it comes to bull markets and bear markets. And let's begin here with the bull market. So the first thing we're looking out for is major indices trading upwards. So when we're looking at stocks, you might look at, for example, the S&P 500, NASDAQ, as I talked about earlier. These are some major indices. So you want to look at multiple indices. But if you look at, for example, crypto, I would instead look at, for example, Bitcoin and Ethereum, and basically the largest cryptocurrencies to get a sense of the bull or bear market. You can see the opposite here is that major indices are in a downtrend. And next, in a bull market, we usually have rising corporate earnings. So earnings reports are usually indicating, growth, while the opposite is true here for the bear market. And here, and this is a very important sort of technical factor you can take into account, that in a bull market, we usually have more volume on bullish days. So when we see green days, we usually have more volume, and the opposite is true here for the bear market. In the bear market, we usually see more volume on days when we are trading down. And by the way, if you want to learn more about how to analyze volume in depth, I highly recommend to check out my video about the volume footprint chart, and I will make sure to link that video somewhere up in the corner. But here, some other factors to pay attention to is, just in bull markets, general positive economic data. So you can look at things like, inflation, as I talked about earlier, employment, and so on and so on. And the opposite here for bear markets, as you can notice, this list is pretty much always the opposite on the bear market side, right? But here, and this is actually very important, in bull markets we tend to have lower volatility. So one index you can look out for is the VIX index. So in bull markets we tend to have a VIX below 20, while in bear markets we tend to have higher volatility, and the VIX tend to be above 30, or at least tend to be above 20. This middle ground between 20 and 30 can be an early warning sign. Another thing you can look out for in bull markets is that most stocks will trade above the 200-day moving average, and in bear markets you can look out for an inverted yield curve. But right, so now it's finally time to take a look at what I think many of you guys, clicked this video for, and that is, trading strategies for both markets. What are some trading strategies we can use to approach these different kinds of markets? And let's begin here by the bull market strategies. Well, one is strategy, investing strategy that works very, very well in bull markets. It is growth and momentum investing, because when we have a general, a general bull market, a general uptrend, high growth stocks, especially in leading sectors. So for example, think about, artificial intelligence right now. The stocks are performing super good, and they tend to outperform in bull markets. So this can be a very valid strategy in bull markets. Another very valid strategy in bull markets is the simple buy the dip strategy. Look out here for pullbacks as buying opportunities, and on my YouTube channel I have tons of videos that you can learn about how to find these pullbacks. And you can also especially try to trade these quality stocks, and you can actually combine this by trading the growth and momentum stocks. So you can try to buy pullbacks in momentum stocks to try to get the best of both worlds. You can also, in bull markets, this is a little bit more advanced, but you can use tactical leverage. So you can consider things like margin or leverage ETFs. In simple terms, leverage is basically when you use sort of borrowed money to amplify or increase your potential profits, but you will also increase your potential losses. But in a bull market, you will, as long as you are going long, the profits, if you use leverage, it will compound, and you will basically make a lot of money if you use leverage in a bull market. However, some important risks I also include here is overconfidence. This is very important. Some people get way too confident in bull markets. They use too much leverage. And then when the inevitable bear market hits, they can lose a lot. So don't be overconfident. And if you use leverage, make sure to use your brain and be smart about it. Don't, go in and use, 100x leverage. That is never a good idea. But what about the bear market strategies? Well, one of the main strategies you can use in bear markets is short selling. And this is right off the bat a bit more advanced. This is when you make money from the prices going down. You bet that the prices will go down. And I do have a short video where I explain, long and short selling. So I highly recommend to check that video out if you want to learn more. Another super valid strategy, and I have so many videos about this, is to use technical analysis combined with short selling. So technical analysis is when you analyze charts, you analyze the psychology of price movements, and you can use that analysis to find these shorting opportunities. But if you are someone that only likes to go long, so you don't want to short, you think that's too complicated, then you can focus on more defensive opportunities, like for example investing in high quality companies that you believe in the long term will perform well. You can also invest in sort of these shorting ETFs and even put options, but that is a bit too advanced. And some risks with bear markets here is to fight the trend too early. But right, so if you want to learn more about longing and going short, I highly recommend to check out this video next. But for now, guys, take care. Ciao, ciao.